All right, so in our first main lecture, we're talking about Forex. What is Forex? What is Forex? And then the agenda for this particular course will be, first, we'll have introduction, and then we'll define Forex. We'll talk about the participants in the Forex market, the major currency pairs, how Forex trading really works. Then we'll also discuss about benefits and risks of Forex trading, and then we'll conclude for tonight. So this course basically is on the introduction to foreign exchange market. Remember I told us earlier that Forex is a short form for foreign exchange. So the FOR is for foreign, while the EX there is for exchange. All right, are we good? Okay, so by way of introduction, you're welcome to this introductory class on Forex. And in this session, we'll explore the basics of Forex trading and gain a better understanding of what Forex is all about. So we'll talk about what Forex is all about. Okay, so now what is Forex? Forex, in short, stands for foreign exchange, and it refers to decentralized global markets where currencies are bought and sold. So whenever I'm having a class or a session with Nigerians like this, okay, and that was why I asked for our location, I usually make reference to our local Abuki currency exchange guys that usually exchange money for us. You know, they will exchange dollar to naira, pound to naira, and the likes. Or we have our BDCs, our Bureau de Change. All right. So that market where currencies are bought and sold is the foreign exchange market. Okay. So what we are now doing now as Forex traders is that we are also participating in the market to make profits off the market. So the rate of fluctuations, okay, or let's say the next points that we have here. Say that, and Forex market is the largest and most liquid financial market in the world, with a daily trading volume exceeding trillions of dollars. So it means that every day in the Forex market, we have money flowing, trillions of dollars are being exchanged, right? So we take advantage of the rise and fall of the value of different currencies to make our profit from the market, okay? And then in continuation, Forex trading involves speculating. So now get this, we speculate on the fluctuations in the exchange rates between different currencies. So that was what I was trying to explain the other time. So it involves speculating on the fluctuations in the exchange rates between different currencies to make our own profit of the market, all right? So you can speculate that the value of a particular currency, because of so reason, is going to rise. So because you look forward to it that it's going to rise, you buy enough quantity of that currency now. And then by the time it rose, right? By the time you see that the value has increased, you sell it, and then you make your profit within a day or within 2 days. You get what I mean, right? So maybe, for example, somebody comes to meet you and then tell you that, can you buy this pen? And then you buy a pen for, let's say, $100, right? And you have seen or you've heard somewhere that in the next 2 hours, that pen is going to increase in value from $100 to, let's say, $200. Then you go somewhere and you quickly buy like 10 of that pen. That means you've invested $1,000 into that pen, right? And then after 2 hours, by the time it is announced that that pen, the value of that pen is now 200 naira each, then you go ahead to sell all the 10 pens that you have. And then at the end of the day, your money is now $2,000, right? So that is how Forex is. through different speculations and through different instruments, you know, or you speculate, let me put it that way, that the rate of the currency is going to increase or reduce. So that now instructs your decision whether to buy or to sell a particular currency so that you can make profit of the market. I hope you understand what I'm trying to say. All right, so who are the participants in the Forex market? Who are the participants in the Forex market? One, we have the central banks. So the central banks are the primary players in the Forex market because they are responsible for managing monetary policies and stabilizing their respective currencies. Okay, so the central banks, they are the main players. I remember when we started off, right? I mentioned that you need to be very patient with the market. So the fact that your setup did not form up in a day, or the fact that you opened your chart in a day, does not mean that you have to compulsorily enter a trade before you leave there. No. So you don't determine what happens in the market. It is the big banks, the central bank, commercial banks, news, different things which we are already going into now, that determines what happens, the fluctuations in the market. So you calm down to see what the market is saying before you take decision and enter a trade. If you decide to go ahead of what the big players are saying, you end up losing your money, all right? It's just like a sheep and a shepherd. The sheep should not go and leave the shepherd, or else that sheep will get lost, all right? So that is what this means also. And that is why you need to understand that we don't determine what happens in the market as retail traders. We are retail traders. The big banks does, the government does, all right? So the participants in the forex market, we have the central banks. So we have the commercial banks. The commercial banks facilitate transactions and they provide liquidity in the market, serving both their clients and their own interests. All right, so the commercial banks. And then 3, we have the big corporations that engage in forex transactions to hedge against currency risks and associates that are associated with international trades. All right. Recently, we saw what was happening with one of our big oil moguls in Nigeria, right? And then, in fact, even with small businesses, we see what is happening with the foreign exchange rates that CBN had to come up with between last year and now, had to come up with different monetary policies to be able to ease business transactions, especially those who are transacting in foreign currencies, right? So big corporations also does, all right? And then lastly, we, the retail traders, all right? Individual traders like you and I, who also participate in the forex market through online platforms. Okay, so now let's go to the currency pairs. We talk about the major currency pairs. There are also other minor currency pairs that we won't really talk about in this class, all right? But by the time we go into MT4, we start going through the, what's it called? The tutorial of the MT4, all right? We'll see all the currency pairs that are available, okay? So the major currency pairs are the most actively traded pairs in the forex market. So we call them major because they are the ones that people trade the most. They are the pairs that people trade the most. And if you are saying currency pair, a pair means 2. You get, right? A pair means 2. So there will be one that comes first, and then there will be the other one. So there's the base currency and the quote currency. Okay. So I believe you can see this image that is here. So the first one is referred to as the base currency, and the second one is referred to as the quote currency. So if you see a pair like this, Euro USD, we call this Euro USD. Euro is spent in the European countries, and USD is spent. This is US dollars, right? United States dollars is spent in United States. All right. So if you see Euro USD and the value is 1.1302, so it means that 1 euro equals to 1.1302 USD. That is what it means. That is what it means. All right. So what are the major currency pairs that we have? I'll give you about 6 of them. All right. So we have the Euro USD. We have the USD JPY. So USD means US dollars. I've mentioned it before. So you need to take note of all this. All right. Then the JPY means Japanese yen. All right. GBP means Great Britain pound. All right. USD means US dollar. Okay. CHF means Swiss franc. That is what is spent in Swiss. All right. This is Aussie dollar. Okay. Australian dollar. AUD means Australian dollar. All right. And then CAD means Canadian dollar. All right. So you need to know, at least as a Forex trader, you need to know what all these are called. All right. There are some times that, in fact, instead of mentioning it in full, I can ask you that, so what pair are you trading? And you say EU. If you say EU, I understand that you are saying Euro USD. If you say GU, I understand that you are saying that, okay, you are trading Great Britain pound USD. All right. If you say HU, I understand that you are trading Aussie dollar and US dollar. All right. So those are the major currency pairs that are being traded on the Forex market. All right. I hope you get that. I'm just trying to go on and on so that we can cover at least a lot tonight before we close for tonight's session. All right. Now, how does Forex trading works? I think I mentioned it before. Forex trading involves buying one currency while simultaneously selling the other currency. Okay, you get that? So it involves, remember the last slide that we saw, that there are always two pairs. So it involves you buying one to sell another or selling one to buy another. All right, that is how Forex trading works in simple terms. And currency pairs are quoted in terms of their exchange rates, which represent the value of one currency relative to another. All right. So therefore, traders aim to profit from the fluctuations in the exchange rates by speculating on whether a currency will appreciate or depreciate in value over time. All right. So that is how we make our profit in the Forex market. Okay. So basically from the fluctuations in the exchange rate by speculating whether a currency will appreciate or depreciate in value over time. So now let's look at benefits of Forex trading. We'll look at 6 of them. All right, number 1, high liquidity. So due to the massive trading volume of Forex every day, Forex offers high liquidity, ensuring ease of buying and selling of currencies. All right, so the high liquidity had given us the opportunity to buy and sell currencies easily. All right. Another benefit of Forex trading is that it is a 24 hours a day, 5 days a week market. So it means that it allows traders to participate at their own convenience, right? However, this is determined by the zone, the market that you are trading with, the currencies that you are trading with. All right. So there are different, what's it called? There are different zones or trading zones. Like we have the USD market, the American market, and it has its own time frame that we trade the USD instruments. We have the London market, we have the Asia market, all right? So they are different. So if you are trading, if you are a trader that you trade the American market, that's the New York market, then you need to look out for the hours that the banks in United States are opened, all right? If you are trading the London market or the Euro market, all right, you need to look out for the hours that the banks in Germany are opened, all right? If you are trading the London market, you need to look out for the hours that the banks in London are opened, all right? However, these different markets overlaps each other. And then at the end of the day, we see that in 24 hours a day, 5 days a week, the Forex market is always opened. All right. There's also the Asia market. All right. Talking about the Tokyo. Okay. So that's another benefit there. And then you have the opportunity to work remotely from anywhere in the world. As long as you have your internet access, you're able to access your trading charts, all right? You have the opportunity to work from anywhere in the world, all right? Number 4, we can leverage our trading. Forex brokers provide leverage, which allows traders to control larger positions with smaller amounts of capital, all right? So as we continue in this course, we'll talk about leveraging, okay? So you can see someone that has an account of, let's say, $1,000, and is trading with fund of, let's say, $10,000, all right? So you can leverage your trading. How is this possible? By the time we go on in this course, we are going to see how you can actually leverage your trading, and then which means that you have the opportunity to make more profit, all right, when you leverage your trading. Okay, number 5, you can start with minimal capital. In fact, with the introduction of micro account or cent account, okay, you can start with as little as, let's say, $50, $10, $20 to trade. And then standard account or ECN account, majority of them start with about $200, all right, $100 and the like. So you can start with minimal capital. So it's not a venture that you go into that you need to start looking for, let's say, $10,000, $1,000 compulsorily to start. Okay, you can start with minimal capital and then grow from little to small. Okay, and then lastly, another benefit of Forex trading is that you can copy trades. You can copy. There are social trading platforms like, in fact, there's one of the platforms that I am a strategy manager there. All right, and I have quite some persons that are copying my trades. So what happens on that platform is just like you are following someone on Instagram, you're following someone on TikTok and the likes, on Twitter. So what happens is that as long as they've connected their account, their follower account to the leader, as long as you connect your follower account to your leader trader, whatever trade that leader enters, your own account automatically enters the same trade, all right? And as your leader is making profit, you are making profit also. I think I have about 1 or 2 persons in this class that are actually copying my trades at the moment, all right? So that's another benefit of Forex trading. So even if you don't know much, you don't know how to trade, you can still benefit from the market, all right? So now, what are the risks of Forex trading? I'll mention 3 here. Volatility. The Forex market is highly volatile, with exchange rates fluctuating rapidly. So this volatility can result in both profit and losses. So the same way the volatility of the market can help you to make profits, it can also help you to make losses, all right? And that is why when I started, I'm sure you'll have heard me talking about risk management, money management. That is why we have principles to manage our risk so that we don't lose to the volatile market, okay? Number 2 is leverage risk. Why leverage can amplify? So in the last slide, I mentioned about leverage that can help you to make profit. So now is another risk. So the way leverage can help you make more profits. It can also make you to have huge losses. All right. So traders should exercise caution and manage their risks effectively. So all this we are going to learn in this course, how to manage your risks effectively so that none of this will affect you. Okay. All right. And then there are also market risks like economic and geopolitical events. These are the things that can also impact currency values. Like the time when we had the global pandemic, all right, there was impact on the currency value, okay? And it could make Forex trading inherently risky also. All right. So in conclusion in this session for tonight, so I'm going to stop here for tonight, and then tomorrow we go on in the next lecture. So in conclusion tonight, Forex trading is an exciting and dynamic market that offers opportunities for profiting to trader. All right. And then understanding the basics of Forex, including the participants, major currency pairs, and trading mechanisms, is essential for our success. So if we must be successful, it is important that we understand these basics that we've talked about tonight. And then always remember to exercise caution, all right? Manage your risks and continue learning to navigate the complexities of the Forex market. So thank you very much. I want to believe that you have found this introductory class on Forex informative. If you have any other questions or you want to explore Forex in details, you can feel free to message me. All right. Happy trading. So tomorrow we will continue in our next class. All right. So